Welcome, everyone, and thank you for joining the CFA Society Switzerland's webinar on the Swiss National Bank's monetary policy implementation to COVID-19. Please use the Q&A symbol to ask questions. After the presentation, these questions will be discussed with our speaker. Our speaker today has unique insight into the SNB response to the economic effects of the COVID-19 pandemic. Mark Zimmermann was appointed to the position of head of head of money market and foreign exchange at the Swiss National Bank, SNB. During his career with the SNB, he has represented the SNB on various global and national working committees and has participated in technical assistant missions of the IMF. Welcome, Marcel.
Thank you very much, Sheila. Thank you for having me for this webinar. Let me quickly upload my presentation. I brought a few slides with me, but we will leave plenty of time for Q&A at the end of the session. So I hope you see all the slides now on your screen. I'd like to start with, here we are, with an overview slide to basically give you a bit of a bird's eye view how the COVID-19 crisis affected the global financial system and the real economy. And then I will go into details of what the SNB did in order to also ease the strains in markets and conduct our monetary policy accordingly. So I took this slide that you can see now from the most recent Bank of England Financial Stability Report. I think it provides a good overview on one page of what happened over the last couple of months, particularly during February and March of this year. And if I start on the left-hand side in the blue box, you see that the COVID-19 shock basically led to an adjustment in asset prices and a flight to safety. Risky asset prices fell, market liquidity deteriorated, volatility jumped, and the investors sought safer and more liquid assets. That could be government bonds, but for Switzerland, it mainly means that investors seeked the Swiss franc in FX markets as a safe haven. When we move to the right, these market adjustments led to an abrupt and extreme dash for cash. I'll not go into all the details here in that box, but it led to what it calls margin calls on derivative positions. It led to an increased demand for liquidity. Investors withdrew from money market funds. So these were all the repercussions caused by the COVID-19 crisis in the financial system. If we turn to the bottom part of this slide, have a look at the real economy, you see the impact that financial markets had on the real economy. It became increasingly more difficult for some borrowers to access capital markets. That was not so much an issue here in Switzerland. We have a corporate bond market that is mainly tapped by highly rated corporates. Therefore, they were not shut out of markets, but they had to pay a bit of a higher spread vis-a-vis the government bond yield curve. But larger corporates that on a frequent basis do access the Swiss franc capital market, they did not have problems to access capital again during that time if they had a need. But when talking to market participants, when talking to corporations that we have on our contact list at the SNB, we detected that particularly smaller and medium-sized enterprises that do not on a regular basis or not at all access the capital market, that they could get into difficulties in order to access liquidity. And so this was an area that work was done, and I will talk about that later on in my presentation. So all in all, when we move then to the bottom right part, all of these developments in the financial system and the real economy meant that for most central banks globally, this sudden demand for liquidity had to be alleviated by central banks through policy measures that were different among various central banks. Some could, because they had positive interest rates, conduct monetary easing by cutting rates. Other started or increased their asset purchase programs, provided liquidity insurance, and some central banks, including the SNB, cooperated to provide US dollar liquidity to market participants globally. That's also something that I'll talk about on one of the latest slides. So let me address a few points how the COVID-19 crisis impacted us on the monetary policy implementation side. You certainly know that one of the main instruments for a number of years at the SNB are foreign exchange interventions. And alongside the deterioration in markets, particularly during the phase from mid-February to mid-March, when equity markets lost about a third of their value, we saw a significant depreciation pressure on the Swiss franc again. You see on the left-hand side on this slide, the nominal trade-weighted Swiss franc index, starting at 100 in 2019, and we were at about 102.5 at the beginning of this year. Already had a bit of an appreciation of the Swiss franc over the course of January, but then from mid-February to mid-March, the Swiss franc appreciated by another roughly 3 percentage points and traded at an index level of about 106 in mid-March. So we tolerated, on the one hand, we tolerated some appreciation, as you can see, but we also stepped up our foreign exchange market interventions, as you can see on the right-hand side. This chart shows you monthly intervention volumes, as it can be calculated using the SNB balance sheet data. So you see the increase in FX intervention volumes in March and April, in both months, over 20 billion, and the line shows the aggregated volume, which currently this data is published until the end of July, goes up to 92 billion Swiss francs. So that's in excess of 10% of Swiss GDP. So this shows a significant response by the SNB in combating Swiss franc strength on the FX market. Then we also cooperated with other central banks in providing dollar liquidity. This has never stopped. It started in 2008 during the financial crisis, but before the COVID-19 crisis, there was one remaining weekly auction for a 1-week tenor that we conducted. And you can see on the right-hand side in the right chart that there was no demand for dollar liquidity auctioned off by the SNB for quite a while. But the crisis, on the one hand, caused dollar liquidity to become more expensive. A measure of that is visible on the left-hand side, where you can see the difference between unsecured US dollar money market rates and the respective derivative market rate in the overnight index swap. And this spread went up to almost 1.4 percentage points in March of 2020, and caused this response by central banks. On the one hand, cutting the spread that we charge on top of the overnight index rate for the dollar liquidity that we provide from 50 to 25 basis points. So we, together with 5 other central banks that cooperate in this measure, namely the Bank of Canada, the Bank of England, the Bank of Japan, the European Central Bank, and the Federal Reserve, we it reduced the interest rate on these dollar operations. And we also increased the frequency of operations from once per week to daily for the 1 week tenor operation. And we also added an 84-day operation on top of the weekly operations or the 1 week tenor operations. And you see demand picked up for that. In the meantime, as you can see on the left-hand side, the spread went back to the normal level. So this was alongside, obviously, the Fed's own monetary policy action. This was a successful measure to calm down US dollar money markets. And therefore, the demand in the dollar auctions has also diminished in the meantime. And the frequency has been reduced by this group of central banks in 2 steps, on the 1st of July and then on the 1st of September again. So today we will reduce to 2 operations per week, each Wednesday, a 7-day and an 84-day operation. So if we go further, when I spoke on the first slide about possible difficulties by corporations to access liquidity, I said already that it was mainly the assessment that small and medium-sized enterprises could need assistance in that area. So the government, together with the banks, with the SNB, prepared such a package of measures. On this slide, you can see how it works. It allows SMEs, SMEs is here defined for the purpose of this program as corporations with an annual turnover not exceeding 500 million Swiss francs, and they need to be in existence prior to March 1st. To either borrow, if it's a smaller company, to borrow a regular COVID-19 loan. That's the upper part of this slide shows how that works, which is available until 500,000 Swiss francs in terms of the loan amount. For such a regular COVID-19 loan, the intention was to have a procedure that is really very quick, with basically almost no bureaucratic effort. From contacting the bank and applying for that loan, it should basically be able to be processed within a very short period of time, certainly within 24 hours. So what the bank needs to do once the firm has applied for such a loan is primarily check for completeness of information on the respective loan form, and then it can pay out the loan, and it can submit it to the Confederation in order to get a guarantee for 100% of the notional amount of the loan. So this is fully guaranteed. The bank has no credit risk on these loans. The Loan Plus scheme further down under the dotted line is a little bit more complicated in the sense that it involves a loan assessment by the bank. It is this scheme is up for loans up to 20 million Swiss francs, and in the case of these loans, the government guarantees 85% of the notional amount. The remaining 15% is borne by the bank that grants the loan, and the bank is also free to decide on the interest rate for these 15% where it's in the risk. Whereas for the other 85%, in the case of the Loan Plus scheme, the interest rate is set at 0.5%. For the small loans up to 500,000, the interest rate is set at 0%. The final step is, and this is optional, a bank can decide whether it wants to do it, is that each of these loans paid out to a firm, be it a regular COVID loan or a loan plus, can be provided to the SNB for refinancing. So that means a loan that is provided to us will either get 100% in terms of a regular COVID-19 loan or 85% refinancing at the then valid SNB policy rate, so currently at minus 0.75%. The loan has to be submitted as a collateral to us, and we do not take a haircut because it's government guaranteed on the 100 or 85% of the notional amount. If the loan is repaid by the firm, it has to be reclaimed from us, and the refinancement loan from us has to be repaid, obviously, by the respective bank. I should add that this scheme, the refinancing scheme, the so-called COVID-19 refinancing facility, works for these government guaranteed loans. Some cantons in Switzerland have also set up similar loan programs. We also, if all criteria are met, we also accept those loans as collateral for refinancing, or particular programs like the loans that were extended to the airline and near airline sector. They're also eligible to be refinanced. So that was a major step, prepared fairly quickly over the course of March. It was announced on the 25th of March and was operational on the 26th of March. The SNB refinancing facility as basically the last step in this process. We had about, from knowing how the COVID-19 loans guaranteed by the government would look like, we had basically about a week to come up with a technical and operational solution for the CRF, the COVID-19 refinancing facility, in order to provide that also as of the first day of this loan program being in operation. On slide 5, you can see the usage of the COVID-19 loan facility provided by the government. On the left-hand side, you see in the blue line, you see the small COVID loans up to 500,000 notional amount. So about 135,000 of those loans were granted until the facility stopped at the end of July. And for the larger loans between 500,000 Swiss francs and 20 million, 1,130 of those loans were provided, totaling altogether to a notional amount of 16.8 billion Swiss francs. So that's the amount that is outstanding in those COVID-19 loans. And if you look to the chart on the right, you see in percentage terms, the amount of that has been refinanced by banks at the SNB. So this stands around 65%. For the remaining 35%, banks have decided not to refinance those loans at the SNB. As long as the loan is outstanding, they are still eligible to do that. So there is no need to turn over the loan right away after it has been provided to a firm. Banks can also choose to retain the loans and refinance it at a later stage. So all in all, these measures, mainly size-wise, the foreign exchange market interventions, they led to a sizable liquidity injection into the financial system. On this slide here, you see the sight deposits held by financial institutions and other account holders at the SNB. broken down in between domestic bank and other banks, but I think it's enough if you look at the orange line, which shows the total of outstanding sight deposits. So when we purchase foreign exchange, when we grant a loan to refinance COVID-19 loans, this all injects liquidity into the system. And you see that during 2020, sight deposits have increased, to give you the exact numbers, from 587 billion at the beginning of the year to roughly 700 billion right now. So an increase of 113 billion Swiss francs. We also, with effect on April 1st, reduced the negative interest rate charge by increasing the exemption thresholds for banks. So in order to moderate the effect somewhat of the negative interest rate on the banking system and support the banking system in their function to grant credit to the economy, we also adjusted that as a policy decision that was taken in March. The sight deposits are on the SNB's balance sheet on the liability side. If we have a look at the asset side, you see on the flip side of the FX market purchases where we inject Swiss francs into the system, you see the increase of assets, mainly foreign currency investments that the Swiss National Bank is holding. The latest publicly available data at the quarterly reporting point for the SNB balance sheet shows assets of foreign currency investments of 863 billion. You see the increase at the very right of this chart, but if you look back and we put in here some of the major milestones in terms of policy decisions that the SNB took over the last couple of years, which resulted into a growth in the SNB balance sheet as well. So these investments are at a record level, and all in all, if we then compare the policy response from the SNB to other central banks, here you see the balance sheet of the Swiss National Bank in blue, the ECB in red, and the Fed compared to the GDP of the respective countries. You see that the policy response in Switzerland was similar to that of other countries, despite maybe it doesn't look so by the policy decisions taken. There was no additional asset purchase program that was introduced with a big media statement and so on, because the FX interventions that we stepped up, that's an instrument we have been using for quite a while now. So it's an active instrument where we can tailor our purchases to the respective pressure in FX markets and act accordingly without governing board meetings and media conferences attached to that. But the policy response in terms of asset growth to GDP, roughly 20 percentage points. You see in our case, the SNB balance sheet now at about 140% of Swiss GDP. In the US, also about 20 percentage points, but on a much lower level. And in the case of the ECB, up to now, a little bit less than that. But all in all, over those three countries, a similar response by central banks. So before we go to the Q&A session, maybe I could also address, in case it's of interest for some of the audience, a bit more, provide you a bit more a look behind the curtain on how we worked over that time, what it meant actually for the team. So all in all, those operations, the increased volume of FX market interventions, the move for the dollar auctions to provide them not on a weekly basis, but on a daily basis with 2 operations per day. The more frequent interactions with other central banks, be it to prepare for those operations, discuss the auction schedule and other operational aspects, or to talk about markets with other central banks, with market participants. So more market intelligence efforts that were conducted by the SNB over that time, and more internal reporting needs on what is going on in markets. So the governing board met more often to discuss policy options, to discuss strategic implementation aspects of monetary policy. So that meant we had to provide more reports, more presentations in order to brief the governing board what is going on in financial markets. Like probably most others, where it's possible, where you don't have necessarily to work from your institution directly, we decided to make a team split effective March 9th between our primary site and our backup site. So trading activities were still conducted on the monetary policy side exclusively from SNB premises, but split between the 2 locations that we can use for that. But we moved a major part of my team to work from home. So the teleworking part was about 60% of staff was working from home. We are now down, after we've made some adjustments, loosened up a bit our policy. We're now down to 50 or slightly below 50% that works from home. We will look into how things develop over the next few months, whether we want to adjust that more. A challenge that we faced is that staff relocations between Zurich and the SNB office in Singapore became more challenging. We have an office in Singapore for a number of years now, where from my team, 3 foreign exchange traders are located. They usually are on a 1 or 2 year assignment there, and we had a couple of rotations fall into the period from early this year when the COVID-19 crisis started and borders were shut and air travel became more difficult. So we had to see that we could potentially move someone out earlier before a border closure, or have someone there longer. We also increased the staffing a bit as a precautionary measure by 1 extra person that was moved just before Singapore actually closed the border to our Singapore office. And now we just had 1 team member go there to replace someone that is coming back at the end of this month. Now it's more challenging that it's possible to immigrate, but you need to be 2 weeks in a mandatory quarantine somewhere in a hotel in a hotel room that you cannot leave. So the whole bit of the value proposition also for staff to go there to be basically stuck in Singapore, it has changed quite a bit by the COVID-19 crisis. And the outlook, we will see, maybe some of you read the article in the Financial Times that Singapore, that appeared yesterday, that Singapore is generally becoming more restrictive with regards to work permits for foreigners, as it seems. And as I mentioned before, we had quite a strong time pressure set by the crisis, by the government's decision for the COVID-19 loans that were prepared over the course of March to also provide then the respective refinancing facility. But as also during the financial crisis in 2008 and 2009, I think one of the major aspects that I would like to mention that allowed this to be built up within a short period of time. Is just that, and I can provide a strong thank you to my team, that we have very dedicated people here at the bank that are willing to work sometimes day and night for these programs if there is a need to have a policy response ready in a short period of time. So with that, I'd like to stop and hand over to Sheila for the Q&A session.
Thank you, Marcel. That is very interesting. There are a couple questions. Our first question is the SNB able to realign some of its FX denominated holdings into gold and silver, and does it plan to do so?
Okay. Yes, there is no restriction by central bank law. We could, in fact, allocate some of the FX reserves into gold if we wish to do so. It's a governing board decision. The governing board decides on the strategic asset allocation for our reserves. So if, and there's a yearly review process of the composition of FX reserves, but also the question of gold is looked at. The current policy is that we do not have plans to change our holdings, our gold holdings. So over recent years, obviously, when our gold holdings remain unchanged in terms of tons, price fluctuations have been favorable in the big picture. The share percentage-wise, given the increase in FX reserves of gold, has decreased. But we currently do not have plans to purchase gold. We also do not have plans to sell gold at the moment.
Thank you. A question from Roger Schlüssel. Do you expect the additional Swiss 130 billion injected into the financial system since March 2020 to increase inflation?
Well, on the one hand, we would welcome a bit more inflation. So, as you know, maybe I can show that slide quickly. I've prepared an extra slide. What is our economic assessment? The latest one was done in June and published in June at when the monetary policy assessment was conducted. So if you look at the second bullet, our inflation forecast for the current year is negative with minus 0.7% that is projected by us. It remains slightly negative in 2021 before returning into positive territory in 2022, but only barely. So for those that know, we have an inflation target of positive inflation between 0 and 2%. So from that perspective, we would welcome a bit more inflation within our target range. We don't have a point target that we need to achieve like other central banks. But as our inflation forecast shows, the extra liquidity that is in the system, even an increase right now, does not cause inflation to fall outside of our target.
Could you elaborate a little bit on the growth forecast you have on your first bullet point? You see GDP contracting by about 6%. Are you looking a little bit further out at this point?
Internally, yes, we do have internal forecasts that go a bit beyond. The published forecast is only for the current year until the fourth quarter, when we publish a forecast for the next year. Maybe we should have first a look at the last bullet or the third bullet here. So currently, for us, for anyone else in be it a forecasting institution, a bank, other central banks abroad, it is extremely difficult to forecast right now. You would need to know how the pandemic really evolves. So our forecast, and that's shown in the fourth bullet that we published in June, does expect that there is not a second pandemic wave, and that the economic policy measures will succeed in preventing a wave of insolvencies and mass redundancies. So this is very uncertain right now, and we We do our very best to monitor all economic indicators. We also have a network of regional ambassadors that are stationed all over Switzerland, and they speak to companies to get first-hand knowledge of what they see, how their business is evolving. And we take that all together. We have the next monetary policy assessment in the middle of September, so in roughly 3 weeks from now. Then we get a new, we do a new forecasting, or our colleagues, it's not my department, our colleagues in economic research at the bank will do a new forecast for growth, for inflation. But I wouldn't expect that we will not make that caveat again in the press release, also that these forecasts in September, although we now a little bit more, we know a little bit more now on how the economy is bouncing back. So we have some positive and negative signals lately, but I would still expect that we will again say that the forecasts are very very uncertain. We do expect a contraction of 6% this year. We do expect positive growth. I think that has been said at the June statement. We do not give a number yet, but we would expect a further bounce back from mainly the Q1 and Q2 decline that we saw over Q3 and Q4. But overall for 2020, still negative growth, but some further further improvements over the next year, but that growth will remain below the pre-COVID-19 baseline scenario that we had.
But just to clarify, the forecast that you just mentioned assumes no second wave of pandemic.
Correct. Yeah.
Okay. And
so no lockdown again. So basically the environment we're in right now will continue without having further bad effects on the economy.
Okay. And you'll be assessing that during the course of this month to determine whether you need to review that. Okay.
Yeah.
Good. This is a question, actually, more of a long-term question about the interventions by the central banks. Are there any limits to the interventions and the potential effect on distortion of price discovery in financial markets and new bubbles and independence of central banks? And I suppose that is coupled with a Joseph Stiglitz view of the interventions, that is there a post-pandemic economic goal? So, and Stiglitz, for example, says, we're going to be supporting airlines, but not universities. What sort of post-pandemic economy will these interventions involve or result in?
Well, to some degree, there are limits. So in our case, balance sheet growth has been predominantly through purchasing foreign currency. We need to invest those foreign currency proceeds. Those markets are not unlimited in size. We need to determine how much we are willing to hold of a particular market. But these limits are not nearby. So in our case, we look at what is the investable universe that we can tap. So there is much more leeway to conduct operations in our case, and then it's also a risk management aspect. So how much risk are you willing to take for a potential situation where you're abandoning the policies and then the exchange rate depreciates and you're ending up with losses on your current FX holdings. For other central banks that tap their domestic bond market, it's the same equation that we look at. How much is purchasable? How much do you want to get into those markets in order to still retain normal market functioning, that there is some liquidity for other investors, be it pension funds or others that have a genuine interest to also buy those assets, to be able to do that normal bid-ask spreads. So this is a discussion that we constantly have also with other central banks when we meet them at the international forums like the BIS Market Committee, and exchange experiences on that topic. I don't think we're near the limit right now. But then your other question of there's a policy dimension. There are here in Switzerland opinions that we've already done too much. We take those opinions into account, but we have an inflation goal to reach as well. Yeah, in the end, it's on the long term normalization. That's a very hard question. In our case, in case of other central banks that purchase in their domestic bond markets, they can just roll, let their holdings mature. They purchase domestic bonds, and at some point they mature, and they can kind of naturally reduce their purchase program. In our case, that's more challenging because we have to reverse our operations by selling foreign currency and purchasing Swiss francs at some point to normalize our balance sheet. So it's that's only possible under different conditions with good communication and probably in a somewhat stretched out homeopathic in homeopathic doses kind of way.
Very good. That leads into Reto Hausmann's question. Can you give some insights into the current US dollar weakness and euro strength?
Well, we normally do not comment on exchange rates. I think I would echo the assessment that the market has currently, that with the recent policy action in the US, with real interest rates being at their lowest in the US, that the dollar has lost a bit its appeal. Market participants seem to reassess that. I do not have any further insights that I'm willing and able to share on that particular front.
Thank you for sharing what you can. Ali Mueller has a question. More in the distant than close future, the SNB will need to think about implementing an exit scenario. How would your team implement that technically?
Well, I already touched upon this a little bit in my answer to the question before the last one. A bit, I think it's a mixture of announcing that we are now in an exchange rate environment where FX sales would be possible, by finding a communication approach that does not leave the market in too much uncertainty about the volumes that are likely hitting the market, but we can also not be 100% transparent at the same time, ex ante to provide information on our balance sheet reduction measures. So that will be, I think that's all I can say. As the person asking the question rightly pointed out, we're very, very likely a long time away from that point. But it's an important question. It will be a challenge for us to implement at that point.
Thank you.
Maybe after my retirement.
Elena Agram, do you expect government guarantees to become a regular feature of the SNB toolkit, or do you think this was an extraordinary measure not likely to be used for other purposes?
I think in Switzerland, probably more a one-off measure. I think the government has an appetite to broaden or these programs or to use them more frequently. I would not rule out if the crisis has further effects that something would be introduced again. But I don't think that this is that is very likely that this will be much more than a one-off thing in Switzerland.
Okay, good. Roger Schlüssel asked the question, do you consider the yield curve control to be a viable additional monetary tool should the circumstances demand further action?
For us, probably is the question. I think it depends a bit. The Swiss, recently, I would say if you look at the long end of the Swiss government yield curve, obviously the difference to German yields has been fairly small. At some points, it has been inverted even, so that 10-year Swiss government yields were higher than their German equivalent. That's obviously something from an overall monetary policy perspective, given where the difference we have at the short end of the yield curve, although also quite small right now, given the ECB's policy actions over recent years. We would rather like to retain a difference in our favor over the entire yield curve. So in a sense, it could be something to look at some point to also to try to control longer dated yields, but it's I think it has its pros and cons, and if you listen to others that to which have the question has been asked whether they go that way, they see currently more negative aspects of it. As to follow the Japanese model, but it's a measure that we could look into more.
Thank you. There are still a couple of questions and obviously concerns about the second wave potential. There are two questions. I'll give you both of them. What new policy measures, if any, is the SNB considering in the case of a second wave and or increasing insolvencies? And also, the GDP contraction expectations, will it trigger action from the SNB to weaken the Swiss franc?
So if there is a second wave, or if there are further negative effects of the first wave and the overall situation, I think we still have to distinguish between measures that the government takes and measures that the SNB takes. So we're ready with the COVID-19 refinancing facility. If there's more done on COVID loans, government guaranteed, to refinance them. I think the program is up and running. If there is an extra demand, and the facility is reopened for the government's COVID-19 loans, we would refinance them under the existing conditions. Besides that, we don't see that credit availability is constrained. As I said in my presentation, capital market activity has, again, after the initial weeks where it was fairly difficult and spreads were higher, it has normalized in the meantime. We don't see any signals from bank lending or the capital market that it's challenging, extremely challenging, more challenging than before the crisis for credit to be gotten. So I think we would have to see what exactly are measures that in such an environment really can help. Having a stable exchange rate, not having the Swiss franc appreciate more, I think is a cornerstone of that policy mix. We do not deliberately try to or attempt to weaken the Swiss franc, but we try to not have it getting more stronger, to try to prevent it from strengthening. So that will certainly remain our policy approach going forward on the FX side to ensure adequate monetary conditions by preventing the Swiss franc from getting too strong.
And just to mention, do you see any risk of increasing insolvencies, and would that take would you take measures against that?
I think there is a risk. There is an increase of insolvency coming. Depends how big it is. We'll monitor that. We'll assess that in our monetary policy assessments. And factor it into our policy decisions. It depends on the magnitude of adverse reactions in the economy, of what we then have to do in order to stabilize the economy.
Great. Looking long term, is there any concern or plans? Obviously, the pandemic didn't feature well into the timing of reducing the SNB balance sheet. Is there a long-term exit strategy, or what's the current thinking?
No, I mean we are the balance sheet is the result of our monetary policy. So we're not. It's not that we worry day and night about the size of our balance sheet. It's there. It's big. Granted, it's big, yes, but it's the result of necessary monetary policy actions, and in the sense the reduction depends on another environment that allows us to reverse course, to basically tighten monetary policy and tighten it by reducing the size of our assets. When that will come, honestly, no one knows.
This leads into another question that's come. Is a coordinated exit of negative interest rates between the ECB and SNB a scenario being discussed for the foreseeable future? Since Mrs. Lagarde does not seem to be a fan of it.
Well, we think that negative interest rates in our policy setup, that's a good tool. We have no plans to exit from negative interest rates. We changed the system somewhat in two steps last year with the increase of the threshold amounts per November 1st, and again this year per April 1st. So I think we, by taking those steps, we reduced the burden on the banking system. We reduced the likelihood that negative interest rates will be passed on to retail customers. We know that it's a system that not everyone likes, but it's a policy choice that we have to maintain in order to have an adequate interest rate level vis-a-vis other countries. And whether Christine Lagarde likes the negative rates or not, the fact is that the ECB has a negative interest rate policy that is almost at our level, which would, if we would now reduce it and the ECB would maintain it, would have obvious repercussions on FX markets that are not in our interest and not aligned with our mandate.
Thanks. To what extent are you coordinating monetary policy with fiscal policy, and what are the mechanisms and limits of coordinating those two policies?
Well, there's a frequent exchange between the governing board and the Federal Council, with the Ministry of Finance also directly on their intentions. Fiscal policy in Switzerland is happening on the federal, on the cantonal level, in a sense that over recent years it has been fiscal policy has been fairly boring, I would say. Now obviously with the policy response that the government undertook on the design of the program, on the design of the refinancing facility by us, there has been an exchange, but there's no big change in terms of cooperation from previously, and the effects overall, I think, compared to other countries, we started at a good point in the sense that the Swiss government has a lot of leeway given the low debt that is outstanding. There were a number of years in the recent past with budget surpluses, so that it puts us in a very different category from many other countries that have started now into the crisis from already a weak position on the fiscal side, with possible limits on what the fiscal policy can do, and more need to coordinate between the central bank and fiscal policy than in our case.
Thanks. Given one of the key points for monetary policy in Switzerland is managing the Swiss franc strength, to what extent are your policies a reflection of what's going on globally, and how do you factor that into your considerations?
I think it's very much a reflection of what is going on globally. So if you look at, if I just put up again this chart here, so I would say if we look back these 13 years, it was mainly global events. First, the global financial crisis, and then the euro area crisis, the debt crisis in the euro area, that in the end, in the market's view, injected some doubt in the longevity of the euro, whether the concept of a common currency will be held up for eternity, and made the Swiss franc as a safe haven more interesting. Be it domestic investors that previously held unhedged foreign currency exposures abroad, that reassessed that situation and brought it back. So this is a major driver. It's not a predominantly foreign speculation or foreign interest to go into the Swiss franc. It's also, to a large degree, domestic investors that over those years, late 2000s, early 2010s, changed their view on the risks they are willing to hold by investing abroad, and repatriated some of their assets, at least the currency risk. And we're still at the stretches of that of those global effects. The pandemic is a global crisis. It does not hold at national borders, and again, also given the generally otherwise sound macroeconomic conditions in Switzerland, the low debt that I mentioned before by the government, we have obviously quite appealing, that's a positive thing for Switzerland, quite appealing kind of decision points where why investors want to hold some Swiss francs, and that's reflected in the end by the constant inflows that we've seen over recent years.
Thank you. Just something that's on the radar, but not considered key right now, but is coming up, is Brexit. Do you anticipate that Brexit and the effects on Europe and the euro will have impact also in Switzerland?
Short answer would be yes. It depends on what exactly will happen, whether it's still possible to negotiate a trade agreement between the UK and Europe, or whether the UK exits basically on WTO terms. but yeah, the short answer would be yes. UK is a sizable economy. It could have effects on Switzerland as well that are felt here, if not compensated by anything else.
Is that part of your ongoing scenario planning?
It's not at the, I would say, not a top issue for policy making near term, but it's on the risk list, of things. And most risks that we look at are well, tilting the forecast to the downside. So overall, if we look at the risk list, it certainly moves us away even further from, or moves us into the direction of more policy accommodation rather than you can feel safe with the current policy setup.
Can you share us your number one risk on your risk list?
Well, near term, I would say that the dollar decline that has started, the risk events that could further shape where the dollar goes with the US presidential elections in November, that would be, from a near-term perspective, would be the area of risks that I'm most interested to watch right now from an SNB, from my SNB position on the one hand, from my personal position as an interested observer of politics, and what is happening in the US might be quite crucial for the world for the next 4 years or more.
Thank you. I think it's not just a personal interest on the SNB side, so we'll keep an eye on that. But thank you for sharing that. And thank you very much for this really informative presentation. It's been very much appreciated by our members, and thank you very much for the presentation.
You're
and
welcome.
Thank you to our attendees for gaining these insights, and we look forward to perhaps a further conversation with you in the future.